Today I'm joined by Mark Williams, SMA Portfolio Manager from Australian Ethical. Thanks for joining me, Mark.
Thanks for having me.
So Australian Ethical is a key partner for us in our sustainable growth model, which we launched end of last year. So we thought it was a great opportunity to I guess, go under the hood and find out a lot more about Australian Ethical and specific parts of the portfolio that you manage. So maybe if we start by, you give us some background on Australian Ethical and the investment philosophy and what underpins all of that.
Yeah, sure. Well, I guess the first thing is Australian Ethical's been around for 35 years. It was founded back in 1986, and I think one of the key insights the founders had then was that financial markets could be used to drive positive societal change, and so what they put in place at the time was an ethical charter, and that really guided their investment decisions at the time, and to be honest still guides our investment decisions today. And really, I guess what that's about is allocating capital to companies doing good and avoiding those doing harm. And like I say, that's been in place for over 35 years now.
So Australian Ethical is a 35-year overnight success?
That's right. And I think you could say that in the early days it was a little bit ahead of its time. Yeah. And really, I joined the business 5 years ago, and even in that shorter period of time, you've really seen the growth of this style of investing, and individuals, I think, wanting to put their money to do good, and obviously that means different things to different people. Yeah. But it's been what we've seen, a really powerful wave over the last few years, particularly. But I think amazing to think that it was set up 35 years ago, and we're still following that style of investing today, and it is all encompassing for us in that this approach sits across all of our products. It's not an ESG or an ethical product sitting alongside a number of others. It's our whole philosophy that we follow across, like I said, all of our different products.
Fantastic. So talk about the ethical charter. Obviously that, you said that was the founding point put in place by the founders 35 years ago. What are some of the key tenets or some of the key philosophies that underpin that charter and everything else that goes into Australian Ethical? Because as you said, ethical investing means different things to different people. So I guess what does it mean to Australian Ethical?
Yeah, so the charter's made up of its 23 principles, essentially 12 positive, 11 negative, and I think what's unique about us as well is any company that we invest in has to have a positive. It's not just a negative screen, essentially. And so, some of the positives we're looking for, can be, for instance, in the technology space that makes things more efficient for people to either communicate or live their lives or whatever it might be. There's an element of treating people well, and so from a worker's perspective, that's where sometimes it can be difficult for us to invest in retail types of companies with supply chain transparency issues, and so we're very conscious about those types of things as well. On the negative side, you hear a number of similar types of themes that will come out from, I think, a number of sort of ESG managers around alcohol, gambling, tobacco, but we really, what we're trying to do is look at what a company does and how does it go about it as well, and those two are very important aspects. And so you could end up with a scenario where a company operates in an industry that we think is positive and helpful for society, but if they're going about it in the wrong way, they won't necessarily make it through that screening process as well.
I think that's a really clear explanation in terms of the what and the how. So often you think about the negative side of things, you just screen out specific things that people do or don't do, but then how they go about it is probably that next level of drilling into it a little bit further and understanding what's going on within the business as well.
Yeah.
I think that's a great distinction. So within the Australian Advice Network, AAN Asset Management Sustainable Growth Fund, we've got the Australian Ethical Australian Shares Portfolio, which is an SMA, and you're the portfolio manager. So very well placed to tell us about that portfolio, how it's managed, and maybe how it's different to some of the other funds that you've got in your sort of product suite. Yeah,
sure. I think probably the important thing to understand is the investment process and philosophy are exactly the same. Yeah. The way we set up the SMA portfolio was really to leverage the Australian Shares Fund that we've had. It's been in existence for a number of years, has a really strong track record. The portfolio manager there has been in place for a number of years, and we as analysts on the investment team are contributing ideas to that. So the SMA is really set up to leverage all of that. And so essentially how we go about the portfolio construction process is we start with the stocks in the Australian Shares Fund as a sort of reference of our key ideas. The Australian Shares Fund has about 70 stocks in that portfolio. What's different about the SMA is an SMA portfolio doesn't work so well with 70 stocks in it. And so essentially what we do is we start with those stocks that have already made it through into the Australian Shares Fund, and we add a liquidity screen over the top of that. And really what that does is remove some of the lower liquidity, smaller cap, micro cap names from that portfolio and leaves the SMA with a larger cap type of universe in that regard.
Why is that important?
So we thought it was really important. We spoke to a number of the platforms early on, and they talked about transaction costs and trading in and out of an SMA portfolio, where an investor at the end of the day may only have 20, 25 grand in there, and if you're trying to split that, the weightings across a wide array of stocks, you can end up with really small parcels that you need to trade. So we were really conscious of trying to avoid that, and so we added that liquidity screen so that we're in stocks that A, have a more meaningful weighting, and then also are liquid enough so it doesn't cause any transaction issues on the back end when we're trying to reweight the portfolio.
So you've got that universe, the 70 stocks as the starting point. How do you then use liquidity as a filter, but how else do you sort of manage the portfolio? And maybe even in selecting those 70 stocks that go in the Australia share portfolio, what goes into sort of pulling that together?
Yeah, so I think if we think about our broader investment process as a part of that answer, essentially the ethical screening process is the first step in all of this. And so we cannot, as the investment team, we can't invest in a company until it's deemed to be positive under the screening process. So the first step is that, and that effectively sets the broader investable universe for all of us. And then the investment team, we look at it and we're effectively given a growthy type of universe because of the ethical screening. It leaves us with sectors that we spend a lot of time in: healthcare, information technology, renewables, those sorts of, a smattering of industrials and other things. But some of the sectors we don't end up in, resources and even consumer. And so we kind of have this growthy universe, and then we look at, we're very passionate about the underlying fundamentals. So we're bottom-up, value-oriented type of stock pickers. So we're looking for high-quality assets, good management teams. Balance sheet's really important for us, cash flows, and so we put that through our investment process, our filters, and really come to a view of which stocks have the most valuation appeal in that context. And probably one thing we're really conscious about avoiding is getting into stocks where momentum is really driving share prices in the short term. And you can see that both on the upside and downside. But we try and stay really focused on the underlying fundamentals and take a longer term view of those.
Okay, so 2 follow-up questions to that. When you say balance sheet is really important, what does that mean? What does a good balance sheet look like compared to a bad balance sheet?
Yeah, we don't like a huge amount of debt, to be honest. And obviously some businesses can sustain a higher level of debt, but we're really conscious of thinking about where does the balance sheet sit now versus its growth requirements, and does it have the right amount of capital and structure to support that. And so that's one of the key things we're focused on. Together with that comes cash flow though as well. Yeah. So if it has a high level of cash flow that can sustain the underlying operations, then that sort of feeds into that overall equation. But we don't like getting involved in more highly indebted companies and some that might be speculative as well.
Okay. And the second follow-up question is, you talked about momentum, so avoiding those momentum stocks. So talk sort of about that and maybe an example of what we might avoid.
Yeah, I mean, obviously, you could broadly use technology stocks in that context. I think we take a fairly fundamental valuation approach. We're not averse in the technology space to think about EV to sales types of multiples, but we try and benchmark across not just Australian stocks, but the globe, and thinking about what's an appropriate multiple for a type of business given its growth prospects. And you can see some where those types of multiples, again, EV to sales multiples, might have hit north of 20 times, and we think that's just too much for the type of growth there. An example where we've been in a stock early on, and this is more reflecting the Australian Shares Fund perspective here, was AAN, for example, when it first listed, and we were investors early on, and then the market drove that share price to a point that we didn't think was appropriate for it, and we were happy to sell out. And that's one of the things we try and stick to, is we are happy to sell out of stocks. We don't have, like I said before, we benchmark unaware, so we don't have any requirement to hold stocks specifically. And so we're happy to sell out, and we don't want to take the risk of buying in at the top of the market when the market is already pricing in pretty significant growth sometimes for these stocks.
Okay. The last 12 months, or maybe 14 months now that we're sort of recording this end of April, there's been pretty interesting times for the globe and investment markets. How's your portfolio changed, or how's it been impacted by what's been happening over the last 13, 14 months?
Yeah, okay. I think fundamentally, if I think about our sector exposures, they haven't changed too much. I mean, because of who we are, we have certain sectors that we're always more likely to be overweight in or underweight. And so those sectors that we are typically overweight, and we spend a lot of our analytical time on healthcare, IT, and renewables where it's available. We don't spend any time in resources and consumer. And so there are times, and I think particularly the first quarter this year, you saw a bit of a market rotation out of some of those higher PE types of names, or the tech sectors, and a bit of a shift into some of the cyclical sectors, resources and consumer. We don't follow those shifts. Like I say, we take a fundamental bottom-up approach, and so when those types of shifts happen, sometimes our portfolio might underperform those times. Sometimes vice versa, we might outperform, but we're not intentionally shifting into different sectors like that. And so we really stick to our knitting there. And so coming back to the comment at the start, our types of exposures haven't changed too much, and we haven't intentionally shifted our major weightings away from any of those sectors. They'll always be natural overweights for us, and it's more about, for us, finding the right companies within those sectors that will deliver the returns that we're looking for.
Okay, so you talked about being bottom up, and then you talked about sectors as well. So is the sectors more about the ethical filter, sort of specifically, means you can't go into certain areas, and then the bottom up is just choosing the best companies that you can find and running with those? Is that?
That's a fair way to put it, yeah. There are some sectors that naturally don't come through the ethical screens as much as others, but in saying that, so resources, for example, and coal being the key one there, it's not going to make it through. And there are a number of others that won't as well, but we do have small investments in some lithium and some other commodities that we're looking at. So it's not a wholesale, the entire sector's out.
Yeah, is there any possibility that...
That's right, yeah. So that's right. So we look at it, we don't just say wholesale, like that sector's just a no-go. It's about the types of commodities and even how they're going about that process. So a miner, if it was a lithium miner, let's say, that would make it through from a commodity perspective, but we didn't think they were operating in a way that was appropriate, then they would be out. So our ethics research team is always looking at those sorts of things. What it means, though, on an overall perspective, is that there are some sectors that we have more limited exposures to naturally. And then how we think about it as an investment team is, given that, we tend to focus more of our analytical time on some of those sectors and become sort of knowledge experts in some of those sectors that do make it through the charter and form a significant weight for the portfolio.
Great. Are there any sectors of the portfolio, or any sectors of the economy that you're seeing, particular risks or particular concerns, or things you're thinking about making changes to cater for at the moment?
I mean, I think given where share markets are generally, we're pretty conscious that if you look at certain valuation metrics, then the market's had a pretty strong run for a period of time, and so we're naturally a little bit cautious about that as more value-oriented investors, and you can see some of those multiples really pushing up. We're therefore pretty conscious around that tech space, and we do have some investments in tech stocks. But at the end of the day, we still pull ourselves back to, let's think about the underlying drivers of that company, and do we think it's an appropriate company to be exposed to, within that broader sector. So we're always thinking about those types of things, and so there might be rotations within sectors themselves, as some companies become a bit too expensive for our liking, and so we'll look at others, and so it's that constant kind of re-evaluation, I guess. So not really looking at moving out, like I said, but moving out of sectors overall, but just potentially looking at new opportunities that come up within those sectors.
And are there any, companies that are in the portfolio that you know really well and are particularly done a good job, or particularly interesting stories you might be able to share with us? A bit of a snippet on something like that.
Yeah, I think we're obviously very passionate about the renewables investments that we can make. One of the downsides in Australia, there aren't too many of those available, which is a frustration for us. And one of the larger ones previously was Infigen, and we were investors in that until that was taken over by Iberdrola. So it doesn't leave us with too many opportunities here. What we do like, though, is in New Zealand, there are a couple of really big energy players, Contact Energy, Meridian and Mercury. And effectively they're the AGLs in New Zealand. The difference being AGL has a lot of coal generation, which we don't like. In New Zealand there's a lot of hydro, geothermal and wind.
Okay.
And so those companies are exposed to that. So we really like them, A, for the assets that they have, and not just that they're renewables, they're really good quality assets that provide stable earnings for these companies and then feeds through a nice dividend for us. But I think one of the other elements is, as we move to a more electrified world, there's going to be more demand for the generation for these providers. And so we see this as a great growth opportunity as well for that type of business, where normally you'd expect some pretty modest type of growth as demand for electricity is, at the moment, a couple of % maybe per annum, but we see great opportunity for these companies as the world moves to a more electrified state, and so we see good growth, and like I say, we really do like the assets in these companies.
Fantastic, good stories. I wonder, and this is a question without notice and maybe a bigger talking point, but what do you think it is about the Australian economy or the Australian environment that means we don't have as many of those companies available to you, and what can we do, or what could you, AE, do as a player in this space to try and move the dial on that?
Yeah, it's a good question. I think historically we haven't always had consistent policy, which I think has hurt. Yeah. And you really saw that with the rush of renewables projects that eventually came into the system and is now causing a bit of volatility in the electricity space. So I think that's been a hindrance. I think we're improving in that regard, and you can see where there is appropriate thought going into, it's not just we need renewable generation, but we need to make sure the lights stay on as well. So I think there's improving balance with that, and I think that'll help from an investment perspective. I think the other thing, though, to be honest, is, take the Infigen example, is we have had some good companies, but then when international capital comes in at generally a lower cost of capital than what we can achieve here, then there's a lot of ownership that is not in the listed market here, but is owned internationally. And it means there's still a lot of investment going on. Okay. It's just not in the listed equity space in Australia, unfortunately for us, because we would like to do it. At the small end of the scale, there are some interesting operators that, and an example of that is Genex, and they're trying to develop a pump hydro project in Queensland. Small company, and ambitious targets, and they're trying to do things. But we then need to just try and weigh up, is it an appropriate risk for the return we can see coming out of it. So I think there's a lot of activity. Yeah. It's just in the listed space, unfortunately there isn't that much at the moment.
Yeah. So you're talking about some of those smaller companies like Gen X, and it must be interesting as an analyst to, I guess, get some early insight or some exposure and ability to go and look at things. Particularly, I'd imagine most of your team are pretty passionate about ethical investing, otherwise you wouldn't be there. So, yeah, is that a part of your job that you enjoy, and is that something you get to spend a lot of time on, or how do you manage that?
Yeah, absolutely. I mean, I think for me personally, that's a broader sector that I look at, and so it is interesting. You see a lot of interesting ideas and companies come through our doors,
yeah.
and they're attracted to come and talk to us because of who we are. So that's really interesting. And actually, having said that, more and more we're seeing bigger companies come to us and asking for our input into sustainability reports and different things like that, which is fascinating. But yeah, there are a number of smaller companies that we think are great ideas. The difficult thing for us as the investment team is weighing up that it's great from an ethical screening perspective, but is it also great from an investment perspective? And I think that's what we, on the investment team, are really conscious about, is not just investing in something because it's ethical and has renewable credentials. We love those types of opportunities, but we're really conscious about trying to make sure that it's going to deliver an appropriate return for us, because at the end of the day, we're conscious that individuals are investing their hard-earned savings with us, and so we want to make sure that we can deliver a good return from that. So that's what, from the investment team side of things, we're very focused on delivering as well. So yeah, it's great to see a number of these companies come through the doors though. Yeah,
that's good. It's interesting to hear that larger companies now coming and consulting you more. It's a result of that 35-year track record of delivering in that space and being a leader.
Yeah.
And then on the flip side, I think we've been talking a fair bit and looking at, as we've been putting together that sustainable growth model, do you have to trade off return to invest ethically, which has always been a big question, and I think it's obviously forefront of your mind.
Yeah.
As you just articulated.
No, exactly, and we obviously get that question a lot, and I think we're getting better at finally telling the story that no, you don't have to trade that off at all. And if you look at the track record of, particularly this Australian Shares Fund, has been the longest sort of serving fund in our portfolio, incredibly strong performance over many years, multiple time frames, and that makes us proud to be able to say that we can compete with Australian fund managers across the spectrum, with also having this ethical screening process. And so, that's for us as the investment team, we're benchmarking ourselves against the best in the market, which and they do have a bigger, broader universe. But we're pretty conscious on trying to compete with those, and to date we have, which is great, and hopefully we can keep doing it going forward.
That's right. Keep up the good work.
Thank you.
That's been great, Mark. Thank you very much for sharing your insights and your wisdom, and thank you to your team for the partnership and the great work you're doing for our clients as well.
No worries, Jeff. Thanks for having me.